Carlo, thank you for joining us this morning. Carlo is a private equity investment professional in Stonehenge Capital, and he's joining us today to talk about the market, the economy, business, and the businesses that private equity companies are looking for. So, Carlo, if you want to tell us just a little bit about yourself so the listeners know who you are.
Yeah, that'd be great. Thanks, Alex. Thanks for having me on. So, quick background on myself. Started investment banking, worked at Bank of America Merrill Lynch, healthcare investment banking, then moved over to Cantor Fitzgerald. Been in a fund called Stonehenge Capital for the last about 2.5 years. Middle market private equity fund. We do non-controlling investments, so we don't do full buyouts. We won't buy 100% equity in the company, but we'll buy a minority position in the company. We'll do mezzanine debts, senior debts, typically looking for businesses with $3 or $4 million of cash flow or EBITDA or higher. But certainly some of the same principles that apply to businesses of those size apply to larger businesses, smaller businesses. I'm happy to walk you guys through kind of all that stuff. Last couple things, industry agnostic. We invest into everything except for real estate. So we do technology, media, healthcare, manufacturing businesses, pretty much anything except for real estate. So yeah, that's kind of our background and what we do here.
Great. Just for those people who don't know what EBITDA is, what is that?
EBITDA is basically a proxy or an approximation of profit, cash flow. Stands for earnings before interest, taxes, depreciation, and amortization. And again, it's just kind of a quick back-of-the-envelope way of saying profit or cash flow.
So I'm just going to ask you a few quick questions. These are all your opinion and what you're seeing right now in the economy and in the market in the U.S. What industries are hot right now that private equity companies and buyers are going after?
Yeah, I have two ways of looking at it right now. I'll start with the first being on the conservative side. There seems to be this overarching feeling within the market and the overall economy that there could be a looming, I wouldn't call it recession, but a correction in the public markets. The Federal Reserve claims that they're going to raise interest rates twice, if not 3 times in 2019. So we're a little bit partial towards, I would call, anti-cyclical businesses that if the public markets get corrected, less demand within the economy, that these businesses don't completely tank. So we're looking at pretty steady Eddie businesses, stuff like, even as simple as HVAC businesses. I think this would be pretty relevant to your listeners. HVAC businesses that rely a lot on not necessarily new builds, but long-term maintenance contracts that won't necessarily go away. Even something as simple, again, as like a landscaping business. Services or products that are considered necessities as opposed to a luxury item or a service. That if the economy does tank and individuals or businesses lose 10 to 20% of their revenues or 10 to 20% of their take-home income, that they're not just going to cut those things out. HVAC businesses are great because if the economy tanks, people still need heating, they still need air conditioning, they still need ventilation. So those are things that they will not get rid of. So that's one side.
Right.
That's one side. The other side.
What are more examples of these businesses? So I know you mentioned landscaping and air conditioning. What are some of the businesses that maybe our viewers would be operating?
Yeah, and keeping in mind, I guess, the size and scope of the businesses your buyers may be looking for, I would say businesses that, again, would qualify as anti-cyclical. And for me, one of the great examples of that, businesses that refurbish existing items versus new ones. For example, a great example would be a jet and helicopter refurbishment business. Tons of private jets here in the United States of America. When there's a little hit to the economy, instead of buying a brand new $50 million jet, many of these guys will refurbish existing ones or refurbish their current ones. Jets are on a large scale, but even on a person's home or their backyard. Businesses that focus on refurbishment of existing capital versus buying of new ones, those would definitely qualify as anti-cyclical.
Sounds like a great business.
Yeah.
Speaking of great businesses, in your opinion, what makes a business a good business versus a headache? We both know nobody wants to buy or run a headache business. So what do you consider to be a good business?
Sounds like a simple question, but definitely a complicated answer to it. I would start with some certain qualities. I would start with niche, kind of a micro niche business, a business that doesn't have many competitors. Ideally, 3 or 4 competitors within the area, if not less, would be considered a micro niche. A business that is, I like businesses that are B2B, so you're selling to other businesses versus private individuals or consumers. I like businesses that have recurring revenue. A subscription-based model is ideal, where they have a 3-year contract and they're paying you on a monthly basis where it's hard for them to back out. You have a lot of foresight into what your revenues are going to look like next year. The downside to that is it's hard in the sales cycle to lock in a client or customer. It's challenging, right? It could be a 12-month sales cycle.
Right.
Lock someone in. But if you have recurring revenue, that's great. Strong and existing management, the owner might be leaving, but at least a second or third person in line that has a lot of experience and can run the business as well would be a great quality to have in a business.
Did you say you like B2B businesses or you don't like B2B businesses?
This is my own personal opinion. There's other people out there who would disagree with me, but I personally like B2B businesses. I think businesses are a little bit more rational in some sense. Private individuals will follow the trends and follow what's hot out there. Businesses don't make as rash decisions in terms of canceling their contracts with you to go with somebody else. It's harder to gain a business as a customer, but it's also harder for them to leave you as a customer. As opposed to private individuals, they can easily buy a different jar of jelly or buy a different type of T-shirt, right? It's not that hard for them to change.
Right. What kind of businesses are you and your firm looking to acquire this year? Is there any specific industry that you're focused on, or how would you describe what you're looking for?
Obviously, healthcare is always high growth. It's a necessity. Technology has been booming, obviously, for the last 10, 20 years. That we see no slowdown in that. And generally speaking, the manufacturing sector has never been hotter. From our portfolio companies, the most challenging thing from them, they're telling us, is to actually hire people. They can't find enough talent to execute on the orders and execute on all the business that they're trying to execute on, which is obviously a great sign. In terms of like fundamentals of the economy, that's a great sign. Right now, the economy is running on full cylinders and full steam ahead. Hopefully, if that continues, almost any industry will continue to do well, whether that, again, is tech, healthcare, media, or manufacturing.
There's a lot of talk about market correction and maybe a recession that, according to the news, seems likely. So you don't agree with that view, right? Am I getting you correctly?
So is it a bad thing to have a public market correction? And to be clear, public market meaning, stocks, publicly traded companies. It's not necessarily a bad thing in the long run. It's a short, kind of painful thing. Whether the market corrects downwards 10%, 15, 20%, I think in the long run, people view that as a necessary evil. Also within the private market, venture capital rounds, the valuations on some of these startups are pretty high right now, which for venture capital investors means it's tough for them to deploy the capital. They're finding it challenging to find good deals, the companies at a bargain. Same thing with hedge funds who are investing into public markets. They're finding it hard to find companies that they think are undervalued and that they should invest into. So when the economy is overheating like this, it's usually a good thing in the long run to have a small correction. We feel it less in the private markets, which is what Stonehenge invests into. We don't invest into public companies. But generally, as a whole, I think the fundamentals of the economy are strong and will continue to be strong from what we can see for the foreseeable future.
Good to hear. That's really not what we're hearing in the news. So your company doesn't retain 100% ownership of the business. It's usually part ownership. How long do you usually hang on to the business, and what's the typical exit strategy that you guys employ?
Good questions. It would be different if you're buying the entire company, again, 100% equity, your exit strategy. For us, and it's not dissimilar from some of your buyers, we look to exit within 3 to 5 years. We're not the buy and hold type of investor, and that's based upon our limited partners who give us the capital. For us, the companies we invest into, a lot of times they will sell to a larger strategic buyer. They will sell to private equity funds who is also looking for these types of businesses. But I think what's very important is planning for that exit. A lot of people, they'll come to the end and they're like, hey, okay, we want to sell this business. For example, entrepreneurs retiring. And it's not too late. It's never too late, but they would extract more value and they would have gotten a better deal if they thought about this exit 3 or 5 years before they're trying to sell. So
yeah, absolutely.
I know that's part of your world. Exit planning is important. It's going to give you more value for your company. End of the day, more money in your pocket if you plan ahead.
At the end of the day, everybody's going to exit one way or another, and most companies are not prepared. Most business owners are not prepared to exit. What I see a lot is business owners will want to sell their business, and the business is not ready for sale. So they want to sell today, but it'll take them 2 years to get ready, and who knows what happens with the economy 2 years down the line. So you get companies, and your goal is to improve them and then sell them off to another private equity company or hedge fund. Is that right?
We're less operationally involved. There's some private equity funds that definitely do that. They'll come in, they'll reorganize, they'll fire some people, they'll try and spur marketing and business development to spur growth. We're a little more hands-off. given that we never retain a majority stake in the company. But absolutely, we sit on the boards of many of our companies. I'm a board observer on many of our investments, and we will help them if need be. I'd say a little more of a hands-off approach, generally speaking, than some other players out there in the private equity realm. But yeah, we're looking for growth companies. The entire economy is growing. There's no reason to find or look for companies who are kind of stagnating. If you're not growing right now, you are basically stagnating or probably losing ground, given the overall economy is continuing to grow.
Right. If one of our listeners who are listening right now wanted to contact you, what would be a good reason for them to reach out? How can you help them? When do they need to reach out to you?
From a Stonehenge perspective, we make loans and we make equity investments. We will purchase, call it 20% equity in your company when a business has about $3 million of cash flow or profit or EBITDA, as we mentioned before. So businesses smaller than that, that's not typically what we look at or invest into. If it's that size, then $3 million of EBITDA or higher, yeah, we'd love to have a conversation. That's kind of our focus at this point. And then again, every industry except for real estate. We don't do real estate. We don't do like infrastructure, like hotels or anything of that nature.
Got it. Do you want to let the viewers know how to reach out to you? Should they reach out to you by email? What's best? Phone number?
Yeah, email. Yeah, we can put an email on there if you'd like to do that. Yeah, happy to have a conversation.
Great. Well, thank you again, Carlo, for joining us. It's been very informative. I'm sure our listeners are going to find this very informative as well. Thank you again for your time.
Yeah, thanks for having me. Appreciate it. Thanks, Alex.